Hey everybody, Joshua Phillips here with Churchill Mortgage, and I am sending out a market update not only on behalf of myself, but my wife Amy, our son Jesse. We are the Phillips team here at Churchill Mortgage. If you're working with the Phillips at Churchill Mortgage, we're going to take great care of you. But let's get into a market update. It's been a couple weeks since we've done a market update. Again, today is June the 6th, and boy, let's start where we were a couple of days ago. So earlier this week, I always like to start with some articles from CNBC. This was just a couple of days ago, 6/4. Mortgage demand drops for a third straight week, even as interest rates ease, meaning interest rates getting a little bit better. Well, that was 2 days ago, and today we are moving the opposite direction as rates are heading back up. So let's flip over here to the 10-year Treasury. So I'll often point to this. This is something that you as a consumer can see easily, 10-year Treasury yields. And I tell you, we want to see the 10-year Treasury yield go down. That will generally mean mortgage rates are improving. But I got to say, even though we move a little bit up and down, things have not changed much this year as we've stayed around that 4.5%. which generally is going to mean mortgage rates around 7%. So, I mean, we can look back this year, 2025, we had that spike at the beginning of the year. We had a little bit of a dip in April. But for the most part, we've been around 4.5% on the 10-year Treasury yield, with it shooting up today from 4.4 to 4.5, reversing course with mortgage rates. Now, what does this due to? This latest move is due to the unemployment report. We were expecting a bad number job. Let's see if we can pull up some information on that. We were expecting a bad numbers job, but it was actually a pretty good number job. You know, May payroll increased 139,000 jobs, more than expected. Unemployment at 4.2%. I think what we were hoping for, in one sense of the economy, is worsening employment, more unemployment, which would put more pressure on the Fed to start cutting the Fed fund rate. I always like to add an asterisk that cutting the Fed fund rate doesn't necessarily always mean that mortgage rates are going to improve, but I still think we'd love to see that happen, see if that couldn't help mortgage rates. But the 10-year Treasury yield stays stubbornly high. Well, let's go over here real quick. Last chart we're going to show you here. Now, I always come to this chart. This is mortgage-backed securities. I always like to say that every mortgage professional in America has this screen up, as we are all keeping an eye on what is happening with mortgage-backed securities, which is where mortgage rates most derive their value. Similar and akin to the 10-year Treasury yield. Now, to read this chart, two things you got to know. Green is good, red is bad, number one. And number two, the higher the security price, the better mortgage rates are doing. Now, this is the last 6 months. This is the last 3 months. And you can see we just have not, we've rolled up a little, we've rolled down a little, we've rolled up a little, down a little. Mortgage rates have not changed more than maybe a quarter, 3/8%. In the last 3 months, we've just not seen a lot of movement. Even if we pull back to 6 months, you can kind of see, again, not much movement. We go back to a year. Okay, still kind of in that same thing. And I think that's just the main theme. Rates are staying roughly around 7%, a little better on 15-year fixed, a little better on FHA loans, but they're just not moving much. Rates remain stubbornly high. And to be honest, it's hard to see that dramatically changing. I don't know that anyone out there is saying that rates are going to drop significantly. Hopefully rates are not going to go up significantly. If you're out there looking to purchase a home, I think you just need to be mentally prepared for rates to stay basically in this range. Again, it's just now, if I look at a I think this is a 1-year chart, that probably does represent more like a 0.75% up and down in interest rates from the best rates of last September to the worst rates of December and January. That's a little bigger move, maybe 0.75% change in interest rates from the lows to the highs. But then here recently, again, really just like a quarter, 3% as rates hover around 7%, give or take. As I always say, if you want to have a conversation about your specific situation, about specific rates available for you, we're happy to do that. Have that conversation. kind of hone in a little better on where rates are. And if you need to get pre-approved, we're certainly here to help with a pre-approval for your loan. Now, all that said, we're actually quite busy. I would say June is going to be the best month that our team's had in, quite a while. We're going to close somewhere around $5 million in loans as a team, at which, you may not have a reference point, but that's a good number of loans that we're going to close. So, hey, despite whatever's happening, people are still buying homes. People are still selling homes. And I think we've kind of just started to get used to the current rate environment and probably not seeing a significant change. If you are looking to refinance, there really just is not going to be much value at this point. If we did have a nice dip, I would definitely be saying, hey, take advantage. If we could get down to even where, mid sixes, low sixes, maybe you just need to take advantage of that because we don't know, when we're going to see lower rates. So anyway, but for now, there's really nothing I think that'd be significantly helpful if you're looking to refinance. Anyway, hey, hope you're enjoying this early summer, and please let us know how we can help with your home purchase, or if there's anything you want to discuss on refinancing, we're here to help. Have a great day. Bye-bye.